ExamPrep.School. Wyoming Variable Life and Variable Annuity Insurance Producer. Exam code 12-WY-85. There are 4 practice exams in this series. This video covers Practice Exam 1, which is free. In this video, we will be covering the following major categories for Practice Exam 1. General Product Knowledge. Separate Account. Wyoming Statutes, Rules, and Regulations. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. What does the guaranteed minimum death benefit in a variable life insurance policy ensure? A. That the death benefit will not fall below the original face amount, regardless of account performance. B. That cash value accumulation is fixed at a minimum rate. C. That the insurer pays an additional bonus if investments underperform. D. That policy loans are provided without interest charges. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is A. The correct answer is that the guaranteed minimum death benefit ensures the death benefit cannot fall below the original face amount, regardless of investment performance. Reason B is not correct. This benefit does not guarantee fixed cash value accumulation. Cash values vary with investment performance. Reason C is not correct. There is no additional bonus feature tied to investment underperformance in the guaranteed minimum death benefit. Reason D is not correct. Policy loans accrue interest according to policy terms and are not interest-free. Question 2. Which factor directly causes cash value fluctuation in the separate account of a variable life insurance policy? A. Market value changes of the underlying subaccount investments. B. Alterations to the insurer's general account crediting rate. C. Annual dividend declarations by the insurer. D. Adjustments to policy loan interest rates. The correct answer is A. The correct answer is that cash value fluctuates directly based on the market value changes of the underlying subaccount investments held in the separate account. Reason B is not correct. General account crediting rates do not affect separate account cash values. Reason C is not correct. Variable life policies do not pay annual dividends that directly adjust separate account values. Reason D is not correct. Policy loan interest adjustments impact loan balances, not separate account cash values. Question 3. In variable life insurance illustrations, the assumed interest rate, AIR, represents which of the following? A. The current actual yield of the separate account investments. B. The federally mandated minimum guarantee rate. C. A hypothetical rate selected by the insurer for projecting future cash values. D. The credited rate applied to policy loans. The correct answer is C. The correct answer is that the assumed interest rate is a hypothetical rate chosen by the insurer to project future cash values in policy illustrations. Reason A is not correct. The AIR is not the actual current yield, but a hypothetical projection rate. Reason B is not correct. Regulations do not mandate a minimum AIR. It is selected for illustration purposes. Reason D is not correct. Policy loan rates are separate and not used as the assumed interest rate in illustrations. Question 4. Under the contract exchange provision of a variable life policy, within what time frame can the policy owner exchange for a non-variable policy without evidence of insurability? A. Within 60 days of policy issue. B. Within 6 months after the first premium payment. C. Between policy anniversaries 2 and 3. D. Within 24 months of policy issue. The correct answer is D. The correct answer is that the contract exchange provision allows exchange without evidence of insurability within the first 24 months following policy issue. Reason A is not correct. The exchange period is substantially longer than 60 days. Reason B is not correct. The provision extends beyond 6 months after the first premium. Reason C is not correct. Exchange is not limited to a window between anniversaries 2 and 3. Question 5. When a policy loan is taken from a variable life contract, how is the separate account affected? A. Accumulation units are redeemed to fund the loan. B. The policy's face amount is reduced. C. Investment allocations in the separate account are rebalanced. D. Mortality charges in the separate account increase. The correct answer is A. The correct answer is that accumulation units are redeemed from the separate account to fund the policy loan, reducing the cash value accordingly. Reason B is not correct. Taking a loan does not reduce the policy's face amount. Reason C is not correct. Investment allocations remain unchanged when a loan is taken. Reason D is not correct. Mortality charges are not adjusted upward by taking a loan. Question 6. Which feature of a variable life insurance policy provides flexibility in premium payments? A. A flexible premium option allowing variable payments within policy limits. B. An adjustable interest rate on outstanding policy loans. C. An automatic premium loan provision preventing lapses. D. A surrender charge schedule that decreases over time. The correct answer is A. The correct answer is that the flexible premium option enables the policy owner to vary premium payments within defined policy limits. Reason B is not correct. Loan interest rates do not affect the premium payment flexibility. Reason C is not correct. Automatic premium loans preserve coverage but do not adjust premium amounts. Reason D is not correct. Surrender charges relate to withdrawals, not premium flexibility. Question 7. Which type of load is assessed when surrendering or withdrawing cash value from a variable life policy and typically decreases over time? A. Front-end load. B. Mortality and expense risk charge. C. Back-end load. D. Policy administrative fee. The correct answer is C. The correct answer is that a back-end load, or surrender charge, is imposed upon withdrawal or surrender, and usually decreases over the policy term. Reason A is not correct. Front-end loads are charged at policy purchase, not upon surrender. Reason B is not correct. Mortality and expense risk charges are ongoing, not time-declining surrender fees. Reason D is not correct. Administrative fees are typically fixed or recurring, not a declining surrender charge. Question 8. What does the mortality risk charge in a variable life policy represent? A. A percentage deduction of separate account value to cover insurance costs. B. A one-time fee applied at policy issue to cover underwriting. C. A fixed dollar amount deducted monthly for administrative expenses. D. A surrender fee that declines over the policy term. The correct answer is A. The correct answer is that the mortality risk charge is a percentage of the separate account value deducted to cover the cost of providing the death benefit and associated insurance risks. Reason B is not correct. It is not a one-time underwriting fee. It is deducted regularly based on account value. Reason C is not correct. It is calculated as a percentage, not a fixed dollar administrative expense. Reason D is not correct. Mortality risk charges are separate from surrender fees, which decline over time. Question 9. After a period of higher than expected administrative costs, a policy owner notices that the variable life policy's expense risk charge is being applied at its maximum rate. Which feature best describes how the expense risk charge is structured? A. A flat dollar fee deducted annually from the policy's cash value. B. A percentage of separate account assets subject to a contract-specified maximum. C. A performance-based fee assessed only when account returns exceed a benchmark. D. A per thousand mortality and expense charge applied to the death benefit. The correct answer is B. The expense risk charge is expressed as a percentage of separate account assets, capped at the maximum rate defined in the policy contract. Reason A is not correct. A flat dollar fee does not adjust to account asset levels and is not how expense risk charges are defined. Reason C is not correct. Expense risk charges are not tied to performance thresholds, but to actual expense variances subject to a maximum. Reason D is not correct. Mortality and expense charges are separate line items. The expense risk charge specifically relates to expense guarantees on separate account assets. Question 10. A Wyoming resident mails back a variable life policy to exercise the free look option. Under Wyoming law, within how many days of delivery must the policy owner return the contract to qualify for a full refund? A. 30 days. B. 14 days. C. 20 days. D. 10 days. The correct answer is D. Wyoming law mandates a free look period of at least 10 days from delivery for life insurance policies, including variable life. Reason A is not correct. 30 days is longer than the statutory minimum. Wyoming only requires at least 10 days. Reason B is not correct. While some states allow 14 days, Wyoming statute specifies a minimum of 10 days for free look. Reason C is not correct. A 20-day period exceeds Wyoming's minimum requirement and is not mandated by state law. Question 11. A producer explains that a variable life policy credits net investment returns based on changes in separate account value over each billing period. Which description best matches the net investment return credit method? A. Daily credit based on an average of separate account unit values. B. Monthly credit tied to the percentage change in separate account net asset value. C. Credit based solely on declared dividends from underlying assets. D. Credit determined by subtracting guaranteed interest from gross income. The correct answer is B. The net investment return credit method typically credits policy values monthly based on the percentage change in separate account net asset value. Reason A is not correct. Daily averaging is not the standard method for net investment return credits in variable life policies. Reason C is not correct. Dividends are only one component of total returns and are not used in isolation. Reason D is not correct. Guaranteed interest references fixed accounts, not the net investment return credit for separate accounts. Question 12. A policy's contract indicates an 8% surrender charge in year 1, decreasing by 1% each full year thereafter through year 8. If a policy owner surrenders in policy year 3, what surrender charge percentage applies? A. 5%. B. 6%. C. 7%. D. 8%. The correct answer is B. The schedule starts at 8% in year 1, drops to 7% in year 2, and is 6% in year 3, according to the 1% annual decline. Reason A is not correct. A 5% charge would correspond to year 4 under the schedule, not year 3. Reason C is not correct. A 7% charge applies in year 2, not in year 3. Reason D is not correct. The initial 8% charge applies only in the first policy year. Question 13. A premium payment on a variable life policy is due May 1st, but not received until June 5th. Under the policy's grace period requirements, what provision applies before the policy lapses? A. A 10-day grace period applies for first-year premiums only. B. A 21-day grace period applies regardless of policy year. C. A 31-day grace period applies to all variable life premiums. D. A 45-day grace period applies if loans exceed policy reserves. The correct answer is C. Variable life insurance policies typically include a 31-day grace period for all premium payments before lapse occurs. Reason A is not correct. A 10-day period is too short. Grace applies beyond the first year. Reason B is not correct. While some policies use 21 days, the standard for variable life is 31 days. Reason D is not correct. Grace period length is not tied to loan amounts within the policy values. Question 14. An insured's variable life policy lapsed 18 months ago. To qualify for reinstatement, which condition must be met under the policy terms? A. Policy must lapse less than 2 years ago without proof of insurability. B. Policy must lapse within 3 years and require evidence of insurability. C. Reinstatement allowed within 1 year with guaranteed issuance. D. Policy can be reinstated any time with payment of back premiums. The correct answer is B. Most variable life contracts permit reinstatement within 3 years of lapse, provided satisfactory evidence of insurability is submitted. Reason A is not correct. Proof of insurability is required. No exception for lapse under 2 years. Reason C is not correct. Guaranteed reinstatement without evidence applies only within a short conditional period, not beyond 1 year. Reason D is not correct. Unlimited reinstatement without evidence is not permitted under standard policy terms. Question 15. A policy owner surrenders a variable life policy with a contract value of $100,000 and a surrender charge of $6,000. What is the cash surrender value at the time of surrender? A. $94,000. B. $96,000. C. $100,000. D. $106,000. The correct answer is A. Cash surrender value equals contract value minus any surrender charges, resulting in $100,000 minus $6,000 equals $94,000. However, net of loan or other items can affect it. In this scenario, only the surrender charge applies. Reason B is not correct. Subtracting $6,000 from $100,000 yields $94,000, not $96,000. Reason C is not correct. Ignoring the surrender charge would yield $100,000, which is not the cash surrender value. Reason D is not correct. Adding the charge instead of subtracting is incorrect. Question 16. Which term describes an annuity contract that allows the owner to make premium payments of varying amounts at irregular intervals? A. Flexible premium annuity. B. Single premium annuity. C. Periodic fixed premium annuity. D. Level premium annuity. The correct answer is A. The correct answer is the type that permits multiple premium payments of different amounts and timing, which defines a flexible premium annuity. Reason B is not correct. This option refers to a one-time lump sum payment contract, not varying payments. Reason C is not correct. A periodic fixed premium annuity requires set payment amounts on a regular schedule. Reason D is not correct. Level premium annuities require fixed payment amounts over time rather than variable amounts. Question 17. In calculating the periodic payment amount for a life-only immediate annuity, which actuarial factor is essential? A. Present value of an annuity due factor. B. Future value annuity factor. C. Present value ordinary annuity factor. D. Accumulation unit factor. The correct answer is C. The correct factor for payments made at the end of each period in an immediate annuity is the present value ordinary annuity factor. Reason A is not correct. An annuity due factor applies when payments occur at the beginning of each period, not the end. Reason B is not correct. A future value factor projects accumulation, not present value payment calculation. Reason D is not correct. Accumulation units apply during accumulation, not payment calculation for an immediate annuity. Question 18. Which statement best characterizes a typical surrender charge schedule for a deferred annuity contract? A. A decreasing percentage that applies over a specified period. B. A fixed percentage applied for a maximum of 3 years. C. A deductible amount that increases each year. D. No surrender charges after the second contract year. The correct answer is A. The typical deferred annuity surrender schedule starts with a higher charge that gradually decreases each year over the surrender period. Reason B is not correct. Most schedules extend beyond 3 years and vary year to year, rather than remain fixed. Reason C is not correct. Charges generally decrease rather than increase as the contract ages. Reason D is not correct. Surrender charges usually apply beyond the second year and taper off later, not end after year 2. Question 19. Which investor profile is most suitable for purchasing a single premium deferred annuity? A. A retiree needing immediate guaranteed income. B. An individual seeking flexible liquidity within 6 months. C. A person with a one-time lump sum seeking tax-deferred accumulation. D. An investor planning monthly contributions for a child's education. The correct answer is C. A single premium deferred annuity suits someone investing a one-time lump sum for long-term, tax-deferred growth rather than immediate income or short-term liquidity. Reason A is not correct. This profile needs immediate payouts, which mismatches the deferred nature of the contract. Reason B is not correct. Deferred annuities impose surrender periods and are not suited to short-term liquidity needs. Reason D is not correct. An investor making periodic contributions needs a flexible premium product, not a single premium contract. Question 20. In a flexible premium variable annuity during the accumulation phase, the number of accumulation units credited on each premium payment is determined by dividing the net premium amount by what? A. Accumulation unit value on the valuation date. B. Annuitization factor in effect at purchase. C. Current mortality guarantee cost. D. Unit cap rate established by the insurer. The correct answer is A. Accumulation units are calculated by dividing the net premium by the accumulation unit value on the valuation date for each payment. Reason B is not correct. Annuitization factors apply when converting to payout units, not during accumulation. Reason C is not correct. Mortality costs are fees deducted from sub-account returns, not divisors for unit calculation. Reason D is not correct. Cap rates limit credited interest, not the computation of accumulation units. Question 21. In an equity-indexed annuity, the participation rate refers to which of the following? A. The percentage of index appreciation credited to the contract. B. The annual guaranteed minimum interest rate. C. The spread subtracted from the index return. D. The cap on the indexed interest crediting. The correct answer is A. The participation rate specifies the portion of the index's positive performance that is applied to the contract's value. Reason B is not correct. This describes the minimum guaranteed rate, not the participation rate. Reason C is not correct. A spread reduces returns but is distinct from the participation percentage. Reason D is not correct. A cap sets a maximum crediting limit, separate from the participation rate. Question 22. What does the cap rate in an equity-indexed annuity represent? A. The maximum percentage of index gain that can be credited to the contract. B. The portion of index gain retained by the insurer as a fee. C. The minimum guaranteed interest rate in down markets. D. The percentage subtracted from the index return before crediting. The correct answer is A. The cap rate sets the upper limit on how much of the index's positive return will be applied to the annuity's value. Reason B is not correct. Fees retained by the insurer are separate from the cap on credited gains. Reason C is not correct. A guaranteed minimum rate pertains to downside protection, not the cap on upside. Reason D is not correct. A spread is subtracted from gains, not the cap that limits them. Question 23. A client selects a fixed indexed annuity linked to the S&P 500 with a 6% cap and a 1.5% spread margin. If the index returns 8% during the crediting period, what net interest rate is credited to the contract? A. 6.0%, B. 5.5%, C. 6.5%, D. 4.5%. The correct answer is D. The net interest credited equals the cap rate, 6%, minus the spread margin, 1.5%, resulting in 4.5% because the index return exceeds the cap. Reason A is not correct. This reflects only the cap rate and ignores the spread margin deduction. Reason B is not correct. This subtracts the spread margin from the cap but uses the wrong figures. Reason C is not correct. This subtracts the spread margin from the index return but disregards the cap limitation. Question 24. An annuity contract promises a guaranteed minimum interest rate of 3%. If the declared interest rate for the current period is 2.75%, which rate will be credited to the contract value? A. 2.75%, B. 3.0%, C. 2.0%, D. 2.875%. The correct answer is B. The guaranteed minimum interest provision ensures that if the declared rate falls below the guaranteed minimum, the contract is credited at the minimum rate of 3%. Reason A is not correct. This uses the declared rate but ignores the guaranteed minimum provision. Reason C is not correct. This rate is lower than both the declared rate and the guaranteed minimum, so it's incorrect. Reason D is not correct. This is an average of the two rates, which is not how guaranteed minimums are applied. Question 25. A 62-year-old investor deciding between a fixed immediate annuity and a variable immediate annuity is most concerned about inflation risk. Which feature of the variable annuity best addresses this concern? A. Guaranteed minimum death benefit. B. Payments that vary based on investment performance. C. Predefined fixed payout schedule. D. Tax-deferred accumulation feature. The correct answer is B. Variable annuity payments fluctuate with the performance of chosen subaccounts, offering potential growth that can help offset inflation. Reason A is not correct. A death benefit protects beneficiaries but does not hedge inflation for the annuitant. Reason C is not correct. A fixed payout schedule offers no adjustment for inflation. Reason D is not correct. Tax deferral delays taxes but does not provide an inflation hedge in payouts. Question 26. An applicant selects a single life income annuity. Which element of the contract constitutes the mortality guarantee? A. Accumulation unit value. B. Lifetime payout period. C. Cost of living adjustment rider. D. Death benefit refund provision. The correct answer is B. The mortality guarantee ensures that the insurer will continue making payments for the annuitant's lifetime, provided by the lifetime payout period. Reason A is not correct. Accumulation units apply before annuitization and do not guarantee payments. Reason C is not correct. A cost of living rider adjusts payments but is not the mortality guarantee. Reason D is not correct. A death benefit refund applies to beneficiaries, not to guarantee lifetime payments. Question 27. A couple purchases a joint and 75% survivor annuity. After the primary annuitant dies, what payment will the surviving annuitant receive? A. 100% of the original payment amount. B. 75% of the original payment amount. C. 50% of the original payment amount. D. No further payments. The correct answer is B. Under a joint and 75% survivor option, the surviving annuitant continues to receive 75% of the original payment amount after the primary annuitant's death. Reason A is not correct. That would apply under a full survivor option, not 75%. Reason C is not correct. This reflects a 50% survivor option, not 75%. Reason D is not correct. Survivor options ensure continuing payments, so payments do not cease. Question 28. Under the Securities Act of 1933, which of the following exhibits is not required to be included in a registration statement filed with the SEC? A. Articles of Incorporation. B. Underwriting Agreement. C. Expert Consent Letter. D. Corporate Bylaws. The correct answer is D. The correct answer is corporate bylaws, because the Securities Act's exhibit requirements under Section 10 mandate filing of articles of incorporation, underwriting agreements, and experts' consents, but not corporate bylaws. Reason A is not correct. Articles of incorporation must be filed as an exhibit under Section 10 of the Act. Reason B is not correct. An underwriting agreement is required to be included as an exhibit. Reason C is not correct. Expert consent letters are mandatory exhibits for expert testimony or opinion. Question 29. Under the Securities Act of 1933, broker-dealers selling exchange-listed initial public offerings in the secondary market must deliver the final prospectus to purchasers for up to how many calendar days following the effective date? A. 90 calendar days. B. 40 calendar days. C. 25 calendar days. D. 10 calendar days. The correct answer is C. The correct answer is 25 calendar days because for exchange-listed IPOs, the prospectus delivery requirement extends for 25 days after the registration becomes effective. Reason A is not correct. A 90-day period applies to NASDAQ-listed or unlisted IPOs, not exchange-listed issues. Reason B is not correct. A 40-day delivery period applies to certain OTC distributions, not exchange-listed IPOs. Reason D is not correct. A 10-day period is shorter than any SEC prospectus delivery requirement for IPOs. Question 30. Under SEC Rule 498A, a summary prospectus may satisfy the prospectus delivery requirement if it includes specified items. Which of the following is not required in a summary prospectus? A. Expense ratio and fee table. B. Principal investment strategies. C. Portfolio turnover rate. D. Portfolio manager names and titles. The correct answer is C. The correct answer is portfolio turnover rate because summary prospectus requirements include fees, investment objectives, risks, performance, and management information, but not portfolio turnover statistics. Reason A is not correct. Fee tables are mandatory to disclose all shareholder fees and expenses. Reason B is not correct. Principal strategies must be described to inform investors of fund objectives. Reason D is not correct. Names and titles of portfolio managers are required to identify fund decision makers. Question 31. Which of the following transactions is not subject to the anti-fraud provisions of Section 10, subsection B, and Rule 10b-5 of the Securities Exchange Act of 1934? A. Sale of corporate bonds in the secondary market. B. Tender offer for outstanding corporate shares. C. Purchase of mutual fund shares on an exchange. D. Underwriting of a new municipal bond issue. The correct answer is D. The correct answer is underwriting of a new municipal bond issue because municipal securities are exempt from SEC registration and their initial underwritings are outside the Act's anti-fraud scope. Reason A is not correct. Secondary market trades of corporate bonds are covered by Section 10, subsection B, and Rule 10b-5. Reason B is not correct. Tender offers are regulated by the anti-fraud provisions under Rule 14e3 and Section 10, subsection B. Reason C is not correct. Exchange transactions in mutual fund shares are subject to the Act's anti-fraud rules. Question 32. A variable life insurance producer included overly optimistic performance projections in the prospectus for a new separate account during a sales meeting, implying guaranteed returns. After the market declined, investors sued under Section 10b-5. Under federal securities law, which party is most likely to be held liable for a claim of material misstatement? A. The individual producer who presented the projections. B. The separate account sponsor as an underwriter for issuing the prospectus. C. The insurer's compliance department for failing to supervise the prospectus content. D. The separate account trustee as custodian of the assets. The correct answer is B. The separate account sponsor is deemed an underwriter under Section 10b-5, so liability attaches to the issuer and underwriters who disseminate material misstatements in the prospectus. Reason A is not correct. A producer may face state regulatory actions, but Section 10b-5 liability attaches to the prospectus issuer and underwriters instead. Reason C is not correct. Internal compliance failures can trigger supervisory sanctions but do not directly impose Section 10b-5 liability. Reason D is not correct. A trustee's custody role does not involve preparing or distributing the prospectus, so Section 10b-5 does not target it. Question 33. An insurer is preparing to launch a new separate account to support a variable annuity product. According to the Investment Company Act of 1940, which SEC registration filing must the insurer submit before offering shares of the separate account to the public? A. Form N4. B. Form N3. C. Form N1A. D. Form S1. The correct answer is A. Under the Investment Company Act of 1940, separate accounts funding variable annuities must be registered by filing Form N4 with the SEC prior to public offering. Reason B is not correct. Form N3 is used for separate accounts funding variable life insurance, not variable annuities. Reason C is not correct. Form N1A is used by mutual funds, not variable annuity separate accounts. Reason D is not correct. Form S1 is for corporate securities offerings and does not apply to separate account registrations. Question 34. A variable annuity investor calls the insurer's transfer agent at 4:05 p.m. Eastern on a regular business day to request a redemption of contract units. According to SEC Rule 22C1, which NAV pricing will apply to this redemption request? A. The average NAV of the preceding 3 days. B. The same day's NAV determined at 4:00 p.m. Eastern. C. The next business day's closing NAV. D. The NAV from the previous business day. The correct answer is C. Rule 22C1's forward pricing provision requires redemption orders received after the 4:00 p.m. Cutoff to be executed at the next business day's NAV. Reason A is not correct. Forward pricing prohibits averaging across multiple days' NAVs to protect investors. Reason B is not correct. Only orders received before the 4:00 p.m. Eastern cutoff are executed at that day's NAV. Reason D is not correct. Previous day NAV applies only if the fund closes early, not standard after cutoff requests. Question 35. During a client review, an advisor notes that a mutual fund of the client's variable subaccount charges a 0.65% annual 12b1 fee for distribution and promotion expenses. Under SEC Rule 12b1, which is the maximum total 12b1 fee a fund may impose annually? A. 0.25%. B. 0.75%. C. 0.50%. D. 1.0%. The correct answer is B. SEC Rule 12b1 caps the combined distribution and service fees at no more than 0.75% of average net assets per year. Reason A is not correct. 0.25% is the limit for service fees under certain share classes, not the aggregate 12B1 maximum. Reason C is not correct. 0.50% may be the maximum distribution portion in some plans, but the combined fee can reach 0.75%. Reason D is not correct. 1.0% exceeds the SEC's maximum allowable rate under Rule 12b-1. Question 36. A registered representative prepares a brochure for a variable annuity highlighting hypothetical performance scenarios, including a best case projection with no disclaimers. Under FINRA Rule 2210, which aspect of this advertising violates standards? A. Omitting a discussion of the fund's investment objectives. B. Presenting hypothetical performance without adequate disclaimers. C. Using a small print risk disclosure. D. Including actual past performance data. The correct answer is B. FINRA Rule 2210 prohibits hypothetical or projected performance illustrations unless they are accompanied by clear, prominent disclosures of assumptions and limitations. Reason A is not correct. While including investment objectives is best practice, omitting them is less severe than misleading projections. Reason C is not correct. Readability concerns do not directly breach the prohibition on hypothetical performance without disclaimers. Reason D is not correct. Actual past performance is permitted when presented accurately and with proper context. Question 37. The 7-pay test for determining whether a life insurance policy is a modified endowment contract compares cumulative premiums paid in the first 7 policy years to which of the following amounts? A. The policy's cash surrender value at the end of the 7th year. B. The gross level premium required to fully amortize the policy in 7 payments. C. The net level premium needed to pay up the policy in 20 annual installments. D. The net level premium necessary to fully pay up the policy in 7 annual installments. The correct answer is D. The 7-pay test uses the net level premium that would pay up the policy in 7 annual installments. If cumulative premiums exceed this amount, the policy becomes a MEC. Reason A is not correct. Cash surrender value is irrelevant. The test compares cumulative premiums to a calculated premium threshold. Reason B is not correct. This reflects a gross premium including expenses, but the test uses the net level premium only. Reason C is not correct. A 20-year schedule is incorrect. The test applies specifically to a 7-year pay-up schedule. Question 38. Under the last in, first out, LIFO, distribution rule for modified endowment contracts, a partial withdrawal from a variable life policy is treated as which of the following? A. Return of basis before any earnings are distributed. B. Taxable earnings withdrawn prior to any return of basis. C. Pro rata allocation between earnings and basis. D. Earnings taxed only after the full cash value is withdrawn. The correct answer is B. Under LIFO distribution rules for MECs, earnings are deemed withdrawn first and taxed as ordinary income until all gain is distributed. Only then is return of basis applied. Reason A is not correct. This describes the FIFO method rather than LIFO. Reason C is not correct. A pro rata allocation does not apply to LIFO distribution rules. Reason D is not correct. Earnings are taxed as they are withdrawn, not deferred until full cash value depletion. Question 39. Under federal income tax rules for non-modified endowment variable life insurance policies, how are policy loans treated for income tax purposes under the first in, first out FIFO method? A. Loans are taxed pro rata between earnings and basis. B. Loans are taxed as gain to the extent of earnings under LIFO. C. Loans are treated as tax-free advances against cash value. D. Loans become taxable only if total distributions exceed basis. The correct answer is C. Policy loans from non-MEC variable life contracts are not considered taxable distributions. They are treated as tax-free advances against the policy's cash value. Reason A is not correct. Pro rata allocation applies to certain distributions, not to policy loans. Reason B is not correct. LIFO rules apply to MEC distributions, but loans from non-MEC policies are not distributions. Reason D is not correct. Policy loans are not treated as distributions regardless of basis recovery. Question 40. Under Internal Revenue Code, Section 1035, when a policyholder executes a direct exchange of a variable life insurance contract for a variable annuity, which of the following tax treatments applies? A. Gain is recognized at the time of exchange, but losses are deferred. B. No gain or loss is recognized, and the basis in the new contract carries over from the old policy. C. Basis in the new annuity resets to fair market value at exchange. D. Exchange is treated as a taxable sale followed by a new purchase. The correct answer is B. A direct Section 1035 exchange defers recognition of gain or loss, and the cost basis carries over into the new contract under IRS rules. Reason A is not correct. Under Section 1035, gains and losses are not recognized on a valid exchange. Reason C is not correct. Basis does not reset. It carries over from the original contract. Reason D is not correct. A direct exchange is specifically not treated as a taxable sale and repurchase. Question 41. Regarding dividends issued on a variable life insurance policy, which of the following statements concerning their tax treatment is correct? A. All dividends are taxed as ordinary income in the year distributed. B. Dividends left on deposit accumulate tax-free until withdrawn. C. Dividends used to purchase paid-up additions generate taxable gain. D. Dividends applied toward premium payment are non-taxable returns of premium. The correct answer is D. Policy dividends represent a return of premium and are not taxable when used to reduce or pay premiums. Only interest earned on dividends left on deposit is currently taxable. Reason A is not correct. Not all dividends are taxed. They are generally non-taxable returns of premium. Reason B is not correct. While dividends themselves are non-taxable, interest credited on deposited dividends is taxable annually. Reason C is not correct. Dividends used for paid-up additions are not taxable upon purchase. Taxation may occur on future gains. Question 42. For federal income tax purposes, the cost basis of a variable life insurance policy is defined as which of the following? A. Sum of premiums paid plus interest credited to the policy. B. Cash surrender value plus any outstanding policy loans. C. Total premiums paid less any dividends received and previous withdrawals. D. Accumulated cash value at policy maturity. The correct answer is C. The cost basis equals total premiums paid reduced by dividends received and amounts withdrawn. Policy loans do not increase the basis. Reason A is not correct. Interest credited does not increase cost basis. Basis changes only with premiums and distributions. Reason B is not correct. Cash surrender value and loans do not determine cost basis. Basis is adjusted for distributions. Reason D is not correct. Cash value at maturity is not cost basis. Basis is net premiums paid. Question 43. After heavily funding her variable life insurance policy, Emma's policy became a modified endowment contract. At age 50, she withdraws $30,000 in cash value. Which portion of this distribution is subject to the 10% MEC penalty stamp duty? A. The entire $30,000 distribution. B. Neither portion of the distribution. C. Only the cost basis portion of the distribution. D. Only the earnings gain portion of the distribution. The correct answer is D. The correct answer is that only the gain portion is subject to the 10% MEC penalty stamp duty because MEC withdrawals follow the gain first distribution rule, and the penalty applies to the taxable gain. Reason A is not correct. Taxing the entire distribution ignores that only the gain triggers the MEC penalty. Cost basis is returned tax-free. Reason B is not correct. MEC status imposes a penalty on gain, so it cannot be completely exempt from additional tax. Reason C is not correct. The cost basis portion is returned tax-free and not subject to the penalty. Question 44. Thomas transferred his variable life insurance policy into an irrevocable life insurance trust 4 years before his death. Upon his death, the policy pays a $750,000 benefit. Under federal estate tax rules, what amount of the death benefit is includable in Thomas's gross estate? A. $0. B. $750,000. C. $150,000, the gain portion. D. Cash surrender value plus outstanding loans. The correct answer is A. The correct answer is $0 because the policy was placed in an irrevocable trust more than 3 years before death, eliminating incidents of ownership and excluding the proceeds from the gross estate. Reason B is not correct. Including the full benefit ignores that an irrevocable trust older than 3 years removes incidents of ownership. Reason C is not correct. Calculating only the gain is incorrect. No portion is included if trust transfer occurred more than 3 years before death. Reason D is not correct. Cash value plus loans is irrelevant. The death benefit is excluded when no ownership incidents remain. Question 45. Mike's variable life policy has a cash value of $15,000 a cost, basis of $10,000, and a $15,000 outstanding loan. He lets the policy lapse this year. What amount of taxable income must Mike report? A. $15,000. B. $0. C. $5,000. D. $25,000. The correct answer is C. The correct answer is $5,000 because upon lapse, the outstanding loan is treated as a distribution. The gain portion is the distribution amount, $15,000, minus the cost basis, $10,000, resulting in $5,000 of taxable income. Reason A is not correct. Treating the full loan as taxable fails to exclude the return of cost basis, which is non-taxable. Reason B is not correct. Assuming no tax ignores that loan forgiveness above basis creates taxable income upon lapse. Reason D is not correct. Adding loan and basis double counts. Only gain, loan minus basis, is taxable. Question 46. Under the Investment Company Act of 1940, which description most accurately defines a separate account maintained by an insurer? A. A portfolio of variable contracts commingled with the insurer's general account for risk diversification. B. A discretionary account within the general account used for internal corporate financing purposes. C. A contractual fund segregated from the general account and registered as an open-end management investment company. D. A pooled account used exclusively to guarantee minimum policy benefits under fixed contracts. The correct answer is C. The correct answer is a contractual fund segregated from the general account that is registered as an open-end management investment company under the Act. Reason A is not correct. Separate account assets must be legally segregated rather than commingled with general account assets. Reason B is not correct. Separate accounts are outside the general account and not used for insurer corporate financing. Reason D is not correct. Separate accounts support variable contract benefits, not solely fixed contract guarantees. Question 47. Which characteristic distinguishes a unitized separate account from a non-unitized separate account under the Investment Company Act? A. Designation of sub-account names for investor reporting purposes. B. Issuance of purchase units at a fixed dollar price regardless of net asset value. C. Requirement that dividends be credited monthly to accumulating policy owner balances. D. Representation of policy owner interest by a fluctuating number of units priced daily at NAV. The correct answer is D. The correct answer is that a unitized separate account represents ownership interests as a number of units whose price reflects daily net asset value. Reason A is not correct. Both account types designate subaccount names. Unitization concerns representation of ownership interests. Reason B is not correct. Unit prices are based on daily net asset value, not fixed dollar amounts. Reason C is not correct. Dividend crediting schedules do not define the unitization feature of a separate account. Question 48. Under separate account segregation requirements, which practice is prohibited for an insurer's separate account? A. Using separate account assets to satisfy the insurer's general account policyholder obligations. B. Investing separate account assets in securities approved by the account's investment policy. C. Maintaining assets in a custodian trust segregated from the insurer's general account. D. Allocating investment income exclusively to holders of variable contracts. The correct answer is A. The correct answer is that separate account assets cannot be used to meet general account obligations, ensuring that variable contract holders' assets remain protected. Reason B is not correct. Investing in approved securities is permitted under the account's investment guidelines. Reason C is not correct. Separate account assets must be held in a custodial trust apart from general funds. Reason D is not correct. Investment income is allocated solely to variable contract holders as specified. Question 49. Which duty specifically applies to a separate accounts board of managers under the Investment Company Act? A. Reviewing and approving changes to the separate accounts investment advisory contracts. B. Ensuring that general account liquidity needs are met before separate account distributions. C. Setting premium rates for guaranteed fixed life insurance contracts. D. Underwriting new policies on behalf of the insurer's general account. The correct answer is A. The correct answer is that the Board of Managers must review and approve any investment advisory agreements pertaining to the separate account. Reason B is not correct. The board's focus is on the separate account, not the general account's liquidity. Reason C is not correct. Premium rate setting for fixed contracts is outside the board's separate account responsibilities. Reason D is not correct. Underwriting policies is not a function of the separate accounts board of managers. Question 50. Under the Investment Company Act, which function is the primary responsibility of a custodian bank for a registered separate account? A. Determining the separate account's daily net asset value. B. Establishing the subaccount fee structure and allocations. C. Selecting the investment portfolios available to policyholders. D. Safekeeping and holding legal title to the account's assets. The correct answer is D. The correct answer is that the custodian bank's primary role is to safekeep and hold legal title to the separate account's assets. Reason A is not correct. Valuation and NAV calculation are functions of the account administrator, not the custodian. Reason B is not correct. Fee structures are determined by the insurer and account manager, not the custodian bank. Reason C is not correct. Investment portfolio selection is a management function, not custodian responsibility. Question 51. At quarter end, insurer ACE's separate account includes municipal bonds with quoted market prices and unregistered private equity interests lacking recent trades. When calculating asset values for determining unit prices, which approach best complies with valuation of separate account assets guidelines? A. Apply amortized cost to municipal bonds and amortized cost to private equity interests. B. Use the most recent trade price for private equity interests regardless of age and market price for municipal bonds. C. Mark municipal bonds at quoted market price and value private equity interests using a third-party fair value pricing model. D. Estimate private equity interests via recent broker quotes and carry municipal bonds at par value. The correct answer is C. The correct approach is to use observable market quotes for liquid municipal bonds and employ a reputable third-party valuation model for illiquid private equity interests, ensuring fair value in good faith. Reason A is not correct. Applying amortized cost to both ignores available market data for municipal bonds and fails to use fair value techniques for illiquid assets. Reason B is not correct. Relying on a stale trade price for private equity ignores the requirement for current fair value estimation when no recent trades exist. Reason D is not correct. Estimating private equity by broker quotes alone can lack sufficient rigor, and carrying municipal bonds at par ignores quoted market values. Question 52. An agent receives a purchase order at 2:00 p.m. for a variable separate account. Under unit pricing frequency guidelines, what is the latest permissible time by which the insurer must calculate that day's unit value? A. By the close of business on the following business day. B. Immediately upon receipt of the order at 2:00 p.m. C. By the end of the current business day. D. No later than the close of business on the next calendar day. The correct answer is C. Regulatory guidelines require separate account unit values to be computed at least once each business day by the end of that same business day to ensure timeliness for transactions. Reason A is not correct. Deferring calculation to the next business day violates the requirement for same-day unit pricing. Reason B is not correct. There is no requirement to compute immediately upon receipt. End-of-day valuation suffices. Reason D is not correct. Waiting until the next calendar day extends beyond the permissible end-of-day deadline. Question 53. During an audit, insurer beta discovers that a valuation error affected unit prices by 0.03% of net asset value. Under materiality threshold guidelines for valuation errors, what action should the insurer take? A. Notify current investors and restate past statements to correct the error. B. Ignore the error since it falls below the materiality threshold. C. Adjust the current NAV forward without restating prior statements. D. Suspend unit pricing until a complete revaluation is performed. The correct answer is C. Errors under the materiality threshold require prospective correction adjusting the current NAV forward, rather than restating historical unit values or ignoring errors entirely. Reason A is not correct. Restating prior statements is reserved for material errors exceeding the threshold, not those below it. Reason B is not correct. Ignoring any error contradicts the requirement to correct known valuation discrepancies. Reason D is not correct. Suspending unit pricing is not called for when errors are immaterial. Normal operations continue with a prospective correction. Question 54. In designing a risk tolerance questionnaire for prospective annuity clients, which question format requires an investor to distribute a fixed number of points among different hypothetical portfolios to reveal risk preferences? A. Open-ended question. B. Likert scale question. C. Forced choice paired question. D. Constant sum allocation question. The correct answer is D. The constant sum allocation question requires clients to allocate a fixed number of points across hypothetical portfolio options, which directly measures risk tolerance intensity. Reason A is not correct. Open-ended questions allow free responses and do not enforce quantitative allocation among options. Reason B is not correct. Likert scale questions ask for ratings on a scale rather than allocation of points. Reason C is not correct. Forced choice paired questions require choosing between two statements, not distributing fixed points. Question 55. According to the traditional rule of 100 in age-based asset allocation models, what percentage of an investor's portfolio should be allocated to equities? A. An amount equal to the investor's age. B. 100 minus the investor's years in retirement. C. 100 minus the investor's age. D. An amount equal to the inverse of the investor's risk score. The correct answer is C. The classic rule of 100 prescribes allocating to equities a percentage equal to 100 minus the investor's current age. Reason A is not correct. Allocating an amount equal to the investor's age reverses the rule's intent of reducing equity with age. Reason B is not correct. Subtracting years in retirement rather than current age does not reflect the rule of 100 guideline. Reason D is not correct. Using the inverse of a risk score is unrelated to the rule of 100's age-based calculation. Question 56. Under FINR, A suitability guidelines, what is the minimum investment time horizon generally recommended for a deferred variable annuity? A. 3 years. B. 1 year. C. 5 years. D. 10 years. The correct answer is C. FINRA guidance suggests that deferred variable annuities are suitable for investors with a minimum time horizon of around 5 years to offset surrender charges and market volatility. Reason A is not correct. A 3-year horizon may not allow enough time to recover surrender charges or market swings. Reason B is not correct. A 1-year horizon is too short to justify the long-term nature and costs of a deferred annuity. Reason D is not correct. A 10-year horizon exceeds the typical minimum suitability threshold. Question 57. A 54-year-old executive in the 37% federal income tax bracket has maximized all qualified retirement contributions and seeks additional tax-deferred growth for a lump sum investment of $200,000. Which product is most suitable to meet the objective of tax deferral without contribution limits? A. Roth IRA. B. Non-qualified variable annuity. C. Universal life insurance. D. SEP IRA. The correct answer is B. The correct answer is a non-qualified variable annuity because it offers tax-deferred growth without IRS contribution limits, fitting the high-income executive's objectives. Reason A is not correct. Roth IRA contributions are made with after-tax dollars and qualified withdrawals are tax-free but do not offer additional current-year tax deferral. Reason C is not correct. Universal life insurance provides death benefit protection and cash value growth, but typically has lower growth potential and higher insurance costs than an annuity for pure tax deferral. Reason D is not correct. SEPIR. A contributions do offer tax deferral, but are limited to a percentage of compensation, so they do not accommodate a large lump sum beyond the employer-employee compensation rules. Question 58. A 58-year-old policy owner with a whole life policy carrying a $20,000 outstanding loan seeks to exchange into a variable annuity under IRC Section 1035. Which factor is most critical to address before recommending the exchange? A. Remaining surrender charge period on the existing policy. B. Repayment of the outstanding policy loan. C. Anticipated dividend scale on the current policy. D. Differences in death benefit flexibility. The correct answer is B. The correct answer is repayment of the outstanding policy loan, because any unpaid loan amount reduces basis and triggers taxable gain on the exchanged amount. Reason A is not correct. While surrender charges affect cost, they do not impact tax treatment directly under a 1035 exchange as long as loan issues are resolved. Reason C is not correct. Dividends on the existing policy are irrelevant to the tax-free status of a 1035 exchange. Only loan and basis issues matter. Reason D is not correct. Death benefit flexibility differences relate to product features, but do not affect the tax-free nature of the exchange. Question 59. A 45-year-old insured holds a 5-year-old variable universal life policy with substantial cash value growth, but faces a 10-year surrender charge schedule. The client is considering replacing it with a new policy that offers lower expense loads but restarts the surrender period. Which analysis best determines if replacement yields a net benefit? A. Comparison of initial surrender charge schedules. B. Net present value of expense load and surrender charge differences. C. Difference in producer commission structures. D. Variance in dividend interest crediting rates. The correct answer is B. The correct answer is net present value of expense load and surrender charge differences, because it captures all future costs and credits to determine whether replacing the policy is economically justified. Reason A is not correct. Examining surrender schedules alone ignores ongoing expense loads and the time value of money. Reason C is not correct. Producer commissions do not affect the insured's long-term economic benefit directly in a replacement decision. Reason D is not correct. Dividend crediting rates are not guaranteed in variable products and do not reflect total cost of replacement. Question 60. A 70-year-old estate owner with a taxable estate exceeding the exemption seeks a vehicle to provide liquidity at death to pay estate taxes. Which feature of a variable life insurance policy best addresses this objective? A. Ability to increase death benefit based on subaccount performance. B. Tax-free death benefit paid to the estate. C. Policy loan provision for interim liquidity. D. Premium payments reduce the taxable estate dollar for dollar. The correct answer is B. The correct answer is tax-free death benefit paid to the estate because it provides liquidity to settle estate tax liabilities without further income tax burden. Reason A is not correct. Performance-based increases are uncertain and do not guarantee liquidity when needed. Reason C is not correct. Policy loans provide interim funds but still create an estate taxable liability if unpaid at death. Reason D is not correct. Premium payments themselves do not reduce the estate's value. The death benefit does. Question 61. Which of the following best describes the primary investment focus of a domestic equity growth fund subaccount in a variable life separate account? A. Investing predominantly in U.S. equity with growth characteristics to seek capital appreciation. B. Allocating mainly to U.S. dividend-paying equities for current income. C. Investing in U.S. government short-term debt securities for capital preservation. D. Maintaining a diversified mix of global large-cap value equities for low volatility. The correct answer is A. The domestic equity growth subaccount focuses on capital appreciation by investing primarily in U.S. growth stocks. Reason B is not correct. Growth subaccounts target capital appreciation rather than current income from dividends. Reason C is not correct. This subaccount invests in equities, not government debt instruments. Reason D is not correct. The mandate restricts holdings to domestic growth equities, not global value stocks. Question 62. In an international bond fund subaccount, an investor is most exposed to which risk factor compared with a domestic bond fund subaccount? A. Currency exchange risk from foreign-denominated securities. B. Interest rate risk from longer maturities. C. Liquidity risk due to thin trading in corporate paper. D. Inflation risk driven by U.S. economic changes. The correct answer is A. International bond funds add currency exchange risk on top of standard interest rate risk when holding foreign-denominated debt. Reason B is not correct. Interest rate risk is common to both domestic and international bonds, not unique here. Reason C is not correct. Liquidity risk may occur domestically as well and is not the primary distinguishing factor. Reason D is not correct. Inflation risk exists for all bonds but is not unique compared to currency fluctuations. Question 63. In a variable life contract, the money market sweep option typically invests unallocated account cash values in which of these instruments? A. Short-term, high-quality debt securities such as commercial paper and treasury bills. B. Intermediate-term corporate bonds rated below investment grade. C. Long-term municipal bonds with tax-exempt interest. D. Equity index futures to cover cash imbalances. The correct answer is A. The sweep option places idle cash into high-quality, short-term money market instruments like commercial paper and T-bills. Reason B is not correct. Sweep invests in high-quality short-term, not lower-rated intermediate bonds. Reason C is not correct. Municipal bonds are long-term and tax-exempt, not typical for money market sweeps. Reason D is not correct. Equity futures are not used in money market sweep mechanisms. Question 64. Under typical variable contract provisions, which set of rebalancing election frequencies is usually offered to policy owners? A. Monthly, quarterly, semi-annual, or annual automatic rebalancing. B. Daily, weekly, monthly, or quarterly automatic rebalancing. C. Quarterly, semi-annual, annual, or biennial automatic rebalancing. D. Monthly, quarterly, annually, or on policy anniversary date. The correct answer is A. Standard offerings allow policy owners to choose monthly, quarterly, semi-annual, or annual rebalancing of sub-account allocations. Reason B is not correct. Daily or weekly options are not typical election frequencies in standard provisions. Reason C is not correct. Biennial rebalancing is uncommon and not usually listed. Reason D is not correct. Policy anniversary dates are not standard rebalancing election intervals. Question 65. Todd invests $500 every month in the Growth Opportunities sub-account of his variable annuity using a dollar-cost averaging program. Market value per unit has experienced significant fluctuations over the past year. Which of the following is the most likely benefit of this program? A. It stabilizes the portfolio's time-weighted rate of return by averaging NAV across market cycles. B. It lowers the average cost per share by buying more shares when NAV falls and fewer when NAV rises. C. It guarantees lower yield than a lump sum investment over the same period. D. It reduces overall purchase expenses by consolidating multiple monthly investments into fewer transactions. The correct answer is B. Dollar-cost averaging involves investing fixed amounts at set intervals, acquiring more shares when NAV is low and fewer when NAV is high, which lowers the average cost per share over time. Reason A is not correct. Time-weighted rate of return is unaffected by dollar-cost averaging, since the program influences average cost rather than portfolio return calculation. Reason C is not correct. There is no yield guarantee versus a lump sum investment. Outcomes depend on NAV movements and not fixed program guarantees. Reason D is not correct. Monthly investments are executed separately rather than consolidated, so transaction costs may not decrease as described. Question 66. Under Wyoming law, the insurance commissioner is appointed by the governor with Senate consent and serves a term of how many years? A. 2 years. B. 4 years. C. 6 years. D. Concurrent with the governor's term. The correct answer is C. The insurance commissioner in Wyoming is appointed for a fixed 6-year term to ensure stability and continuity in regulatory oversight. Reason A is not correct. A 2-year term is too short to align with the statutory requirement for a 6-year appointment. Reason B is not correct. A 4-year term does not match the statute, which specifies a 6-year tenure. Reason D is not correct. The term is independent of the governor's term and is set at 6 years. Question 67. Which act provides the procedural framework for the commissioner's rulemaking authority in Wyoming? A. Wyoming Open Records Act. B. Wyoming Data Practices Act. C. Wyoming Insurance Code. D. Wyoming Administrative Procedure Act. The correct answer is D. The Wyoming Administrative Procedure Act establishes the rule-making procedures the commissioner must follow when promulgating insurance regulations. Reason A is not correct. The Open Records Act governs public records, not rule-making procedures. Reason B is not correct. The Data Practices Act addresses data confidentiality, not regulatory rulemaking. Reason C is not correct. The Insurance Code delegates rulemaking, but requires adherence to the Administrative Procedure Act. Question 68. According to Wyoming law, how often must the commissioner examine the affairs of each domestic insurer? A. Annually. B. Every 3 years. C. Every 5 years. D. At the commissioner's discretion. The correct answer is C. Statute requires the commissioner to examine each domestic insurer at least once every 5 years to assess solvency and compliance. Reason A is not correct. Annual examinations exceed the minimum frequency set by statute. Reason B is not correct. A 3-year interval is more frequent than the statutory 5-year requirement. Reason D is not correct. Examinations follow a schedule defined by law, not solely by discretion. Question 69. When conducting a market conduct examination, which area must the Wyoming Commissioner specifically review? A. Claims handling practices. B. Underwriting of reinsurance treaties. C. Investment portfolio allocations. D. Statutory surplus levels. The correct answer is A. Market conduct examinations focus on how insurers handle claims, publish policy information, and treat policyholders in the marketplace. Reason B is not correct. Underwriting of reinsurance treaties is related to solvency, not market conduct. Reason C is not correct. Investment allocations fall under financial examinations, not market conduct. Reason D is not correct. Surplus levels are part of financial solvency reviews, not market conduct. Question 70. After receiving notice of proposed license revocation, within how many days must a Wyoming licensee request a hearing? A. 10 days. B. 15 days. C. 30 days. D. 60 days. The correct answer is C. Wyoming regulations require the licensee to request a hearing within 30 days of service of the revocation notice to preserve appeal rights. Reason A is not correct. 10 days is too brief compared to the statutory 30-day period. Reason B is not correct. 15 days does not align with the regulations requirement. Reason D is not correct. 60 days exceeds the maximum time allowed by rule. Question 71. Under Wyoming statute, an emergency cease and desist order may be issued without prior hearing if evidence indicates what? A. The insurer's financial statements are overdue. B. A rate filing is incomplete. C. A policyholder files a civil suit. D. An unfair trade practice poses an immediate threat to the public. The correct answer is D. An emergency order can be issued when an unfair trade practice threatens the public interest and immediate action is necessary to prevent harm. Reason A is not correct. Late financial statements do not by themselves justify an emergency order. Reason B is not correct. An incomplete rate filing requires correction, not an emergency order. Reason C is not correct. A civil suit does not trigger the commissioner's emergency authority. Question 72. What is the maximum administrative penalty per violation of the Wyoming Insurance Code? A. $500. B. $1,000. C. $5,000. D. $10,000. The correct answer is C. Wyoming law caps administrative fines at $5,000 for each separate violation of the insurance code to enforce compliance. Reason A is not correct. $500 is below the statutory maximum of $5,000. Reason B is not correct. $1,000 does not reach the $5,000 maximum set by statute. Reason D is not correct. $10,000 exceeds the allowable penalty under Wyoming law. Question 73. A subpoena issued by the commissioner during an investigation is enforceable through which court in Wyoming? A. Circuit Court. B. Supreme Court. C. District Court. D. County Court. The correct answer is C. Investigative subpoenas from the commissioner are enforceable by the Wyoming District Court, which can compel compliance. Reason A is not correct. Circuit courts do not handle enforcement of administrative subpoenas in Wyoming. Reason B is not correct. The Supreme Court does not directly enforce administrative subpoenas. Reason D is not correct. County courts lack jurisdiction to enforce these subpoenas. Question 74. Wyoming law requires insurers to retain transaction records for at least how many years after the transaction date? A. 2 years. B. 7 years. C. 5 years. D. 10 years. The correct answer is C. Insurers must keep policy and transaction records for a minimum of 5 years to ensure availability for examination and claims verification. Reason A is not correct. 2 years is less than the required 5-year retention period. Reason B is not correct. 7 years exceeds the minimum requirement of 5 years. Reason D is not correct. 10 years is longer than the statutory minimum retention period. Question 75. The Wyoming Insurance Commissioner is preparing the annual accreditation report to the NAIC. Which item must be included in this report under state accreditation requirements? A. A list of all licensed producers with their principal business addresses and current license status. B. A narrative report on each pending complaint investigation, including claimant personal details. C. Detailed raw data on individual claim resolutions without aggregation. D. A schedule summarizing the annual licensing fees for each line of insurance and statutory references for those requirements. The correct answer is D. The correct answer is the schedule summarizing annual licensing fees and statutory references, because NAIC accreditation requires documentation of producer licensing fees and the underlying statutes as part of the licensing review. Reason A is not correct. Listing producers' names and addresses is not a required element of the NAIC accreditation report. Reason B is not correct. Including detailed complaint narratives with personal data exceeds reporting requirements and violates privacy norms. Reason C is not correct. Presenting individual claim data without summarizing is not part of the accreditation requirements. Question 76. Under Wyoming statute, an applicant for a resident variable life and variable annuity producer license must be at least what age? A. 18 years old. B. 19 years old. C. 21 years old. D. 25 years old. The correct answer is A. Wyoming law requires an applicant for a resident producer license to be at least 18 years old at the time of application. Reason B is not correct. No statute sets 19 as a minimum licensing age, so this is incorrect. Reason C is not correct. Age 21 is above the statutory minimum and is not required. Reason D is not correct. Age 25 exceeds the requirement and is not specified by Wyoming law. Question 77. Which of the following is a requirement for a non-resident seeking a Wyoming variable life and variable annuity producer license under reciprocity? A. Maintain good standing in the home state license. B. Complete 20 hours of Wyoming pre-licensing education. C. Reside in Wyoming for at least 90 days. D. Hold a Wyoming resident license first. The correct answer is A. Non-residents must hold and maintain their home state producer license in good standing to qualify for reciprocity in Wyoming. Reason B is not correct. Wyoming does not impose pre-licensing hours on non-residents under reciprocity. Reason C is not correct. Physical residency in Wyoming is not required for non-resident reciprocity. Reason D is not correct. Non-residents are not required to hold a Wyoming resident license first. Question 78. Under Wyoming law, a producer applicant must submit fingerprints for a background check within how many days of filing the license application? A. 30 days. B. 15 days. C. 45 days. D. 60 days. The correct answer is A. Wyoming statutes require fingerprint submission within 30 days of the application filing to complete the background check. Reason B is not correct. 15 days is too short and not specified in regulation. Reason C is not correct. 45 days exceeds the statutory deadline. Reason D is not correct. 60 days is longer than the allowed submission period. Question 79. How many hours of Wyoming-approved pre-licensing education are required for the variable life and variable annuity producer line? A. 20 hours. B. 30 hours. C. 40 hours. D. 50 hours. The correct answer is A. Wyoming mandates 20 hours of pre-licensing education for the variable life and variable annuity line before taking the examination. Reason B is not correct. 30 hours is not the statutory requirement. Reason C is not correct. 40 hours exceeds the mandated total. Reason D is not correct. 50 hours is not specified in Wyoming rules. Question 80. Which FINRA registration does not satisfy Wyoming's prerequisite for the variable life and variable annuity producer license? A. Series 63. B. Series 7. C. Series 6. D. Series 65. The correct answer is A. Wyoming recognizes Series 6 or 7 registrations for the variable line. Series 63 is a securities agent exam, but does not meet the line prerequisite. Reason B is not correct. Series 7 is accepted for variable life and annuity products. Reason C is not correct. Series 6 is explicitly accepted for the variable contracts line. Reason D is not correct. Series 65 covers investment advisor law not approved for the variable line. Question 81. Every 2 years, Wyoming producer licensees must complete how many hours of continuing education? A. 12 hours. B. 24 hours. C. 18 hours. D. 30 hours. The correct answer is B. Wyoming requires 24 hours of continuing education in each 2-year renewal cycle for insurance producers. Reason A is not correct. 12 hours is below the mandated total. Reason C is not correct. 18 hours is not the statutory requirement. Reason D is not correct. 30 hours exceeds what Wyoming requires. Question 82. Within the 24-hour continuing education requirement in Wyoming, how many hours must be ethics related? A. 1 hour. B. 3 hours. C. 2 hours. D. 4 hours. The correct answer is B. Wyoming mandates that of the 24 required CE hours, at least 3 hours must cover ethics or professional conduct topics. Reason A is not correct. 1 hour is insufficient under Wyoming ethics requirements. Reason C is not correct. 2 ethics hours do not meet the minimum. Reason D is not correct. 4 hours exceed the specified ethics requirement. Question 83. A Wyoming insurance producer license expires on which date under state regulation? A. Last day of the producer's birth month. B. June 30th of each renewal year. C. December 31st of each odd-numbered year. D. The anniversary of initial license issuance. The correct answer is A. Wyoming statutes specify that producer licenses expire on the last day of the licensee's birth month in the renewal year. Reason B is not correct. Wyoming does not use a mid-year June 30th expiration. Reason C is not correct. December 31st odd-year expirations are not used. Reason D is not correct. Expiration is tied to birth month, not issuance anniversary. Question 84. If a Wyoming producer license lapses, within what period may it be reinstated without retaking the licensing exam? A. 6 months. B. 18 months. C. 12 months. D. 24 months. The correct answer is C. Wyoming allows lapsed producer licenses to be reinstated within 12 months of expiration without requiring a new examination. Reason A is not correct. 6 months is too short under Wyoming rules. Reason B is not correct. 18 months exceeds the reinstatement window. Reason D is not correct. 24 months is longer than the allowable period. Question 85. Under Wyoming law, a $10 penalty is assessed for each month or fraction of a month a producer license is expired. Julie's license lapsed on April 15th, and she submits a renewal application on July 1st. What penalty fee must she pay at the time of renewal? A. $20. B. $30. C. $40. D. $0. The correct answer is B. The license was expired for portions of 3 months, April 15th through May 15th, May 15th through June 15th, June 15th through July 1st. At $10 per month or fraction, the penalty is $30. Reason A is not correct. This applies a penalty for only 2 full months and ignores the fractional month rule. Reason C is not correct. This overcounts the number of months by applying the penalty to 4 months instead of 3. Reason D is not correct. Wyoming law does not provide a grace period that eliminates the late renewal penalty. Question 86. Under Wyoming insurance regulations, which practice is classified as twisting in the sale of life insurance policies? A. Offering a policyholder a rebate of part of the premium if they maintain coverage. B. Persuading a policyholder to replace an existing policy by misrepresenting non-forfeiture values. C. Encouraging a policyholder to increase coverage by highlighting legitimate benefits. D. Failing to disclose a policy's exclusionary clauses prior to sale. The correct answer is B. Twisting involves persuading a policyholder to replace an existing policy by misrepresenting the values or dividends of the original contract. Reason A is not correct. This depicts a rebate rather than twisting, as it describes an unauthorized premium return. Reason C is not correct. This describes a straightforward sales recommendation without misrepresentation. Reason D is not correct. This involves non-disclosure rather than active misrepresentation that defines twisting. Question 87. Under Wyoming law, which of the following constitutes a permissible exception to rebate prohibitions for insurance producers? A. Sharing a portion of the agent's commission with an applicant. B. Offering a general group discount on unrelated property policies. C. Waiving the first-year premium for new life insurance policies. D. Providing a promotional gift valued at no more than $25. The correct answer is D. Wyoming law allows nominal gifts valued up to $25 as an exception to the rebate prohibition. Reason A is not correct. Commission sharing with applicants is prohibited as a rebate. Reason B is not correct. General group discounts on unrelated lines do not qualify under life insurance rebate exceptions. Reason C is not correct. Waiving a first-year premium exceeds the permitted nominal gift threshold and is prohibited. Question 88. Which action is defined as misrepresentation under Wyoming insurance statutes? A. Failing to submit a completed application to the insurer. B. Quoting a non-guaranteed dividend rate as if it were guaranteed. C. Declining to insure a high-risk applicant based on medical history. D. Adjusting a policy's premium based on the insured's attained age. The correct answer is B. Misrepresentation involves presenting non-guaranteed policy benefits as guaranteed, which is prohibited under Wyoming law. Reason A is not correct. This describes an administrative omission, not a false statement about policy benefits. Reason C is not correct. This is an underwriting decision, not the misrepresentation of policy provisions. Reason D is not correct. This refers to standard premium adjustments and does not involve false statements. Question 89. Under Wyoming law, insurance advertisements for variable life products must at minimum include which element? A. A statement that past investment performance predicts future results. B. A guarantee of principal return on the investment component. C. Disclosure of the agent's personal commission percentage. D. The full legal name of the insurer. The correct answer is D. Wyoming statutes require advertisements to clearly display the insurer's full legal name to identify the responsible party. Reason A is not correct. Predicting future performance is misleading and prohibited, not required. Reason B is not correct. Guaranteeing principal in variable products is forbidden, not a required statement. Reason C is not correct. Agents are not mandated to disclose their commission rates in advertisements. Question 90. Under Wyoming statutes, which practice by an insurance producer constitutes defamation of a competitor? A. Quoting approved interest rates published by the insurer. B. Comparing policy fees using publicly available documented data. C. Listing competitor complaint ratios found in public filings. D. Asserting that a competitor's insurer is insolvent without any supporting evidence. The correct answer is D. Defamation involves knowingly making false statements about a competitor's financial condition, such as claiming insolvency without proof. Reason A is not correct. Quoting published rates is factual disclosure, not defamation. Reason B is not correct. Using documented data for fee comparisons is factual and allowed. Reason C is not correct. Publicly filed complaint ratios are factual and not defamatory. Question 91. Which action best illustrates coercion under Wyoming insurance regulations? A. Disclosing policy expense ratios in a client presentation. B. Offering a volume-based commission schedule to high-producing agents. C. Providing complimentary training seminars to appointed producers. D. Refusing to conduct business with a producer who sells a competitor's policies. The correct answer is D. Coercion includes refusing to transact business with a producer due to their relationship with a competitor, exerting undue pressure. Reason A is not correct. Disclosing expense ratios is factual information, not coercion. Reason B is not correct. Providing commission incentives is a permissible business practice, not coercion. Reason C is not correct. Offering training is standard support, not intimidation. Question 92. A life insurer applies a 12% higher premium to a variable life applicant residing in Peake County than to another applicant of identical age, health, and risk profile residing in Prairie County. Both counties have equivalent mortality statistics, but Peake County has a predominantly minority population. Under Wyoming statutes, what best describes the insurer's action? A. Unfair discrimination by using residence as a proxy for a prohibited classification. B. Lawful risk classification based on geographic mortality data. C. A violation due to misrepresentation of policy benefits. D. Acceptable differential due solely to administrative cost differences. The correct answer is A. The correct answer is unfair discrimination because the insurer set different premiums solely on residency that correlates with a protected characteristic without valid actuarial justification. Reason B is not correct. Residence was not supported by distinct mortality data, so it doesn't qualify as a lawful risk classification. Reason C is not correct. No misrepresentation of benefits occurred. The issue is unfair discrimination in premium setting. Reason D is not correct. No evidence of higher administrative costs justifies the premium differential based on residency. Question 93. Under Wyoming statutes governing variable insurance, which document is required to be filed with the insurance commissioner by a life insurer upon initial establishment of a separate account for variable contracts? A. Plan of operation and trust agreement for the separate account. B. Summary prospectus detailing subaccount objectives. C. Audited annual financial statements for the separate account. D. Commission schedule for variable contract sales commissions. The correct answer is A. The plan of operation and trust agreement must be filed for approval to ensure the separate account is established and managed according to statutory requirements. Reason B is not correct. A summary prospectus is delivered to investors but is not the document filed with the commissioner when creating the account. Reason C is not correct. Audited financial statements are required annually but are not the initial filing for account establishment. Reason D is not correct. Commission schedules relate to producer compensation and are not part of the required account establishment filing. Question 94. According to Wyoming law, assets in a separate account backing variable life contracts must at all times be sufficient to cover which of the following? A. Cash surrender values guaranteed under policy provisions. B. Gross premiums received for all issued variable policies. C. Reserve liabilities under the standard valuation basis, plus any asset valuation reserve. D. Total accumulation values credited to policyholders without reserves. The correct answer is C. Wyoming statutes require separate account assets to equal reserve liabilities calculated on the standard valuation basis, plus an asset valuation reserve to protect against market fluctuations. Reason A is not correct. Cash surrender values alone do not represent the full reserve requirement under Wyoming law. Reason B is not correct. Gross premiums collected may fund reserves but are not the statutory measure of required account assets. Reason D is not correct. Accumulation values lack inclusion of the required statutory reserve liability and valuation reserve components. Question 95. Under Wyoming statutes, a separate account's investments in any single corporate issuer's debt obligations may not exceed what percentage of the account's aggregate assets? A. 15%. B. 10%. C. 5%. D. 25%. The correct answer is C. Wyoming law limits exposure to any one corporate debtor by capping investments in that issuer's debt at 5% of the separate account's total assets. Reason A is not correct. A 15% threshold exceeds the maximum percentage allowed by Wyoming rules. Reason B is not correct. A 10% limit is higher than the statutory cap for single issuer debt in separate accounts. Reason D is not correct. A 25% concentration is well above the statutory limitation for separate account investments. Question 96. Under Wyoming rules, before a variable life policy form may be used or delivered, it must be filed with the commissioner at least how many days in advance? A. 20 days. B. 60 days. C. 45 days. D. 30 days. The correct answer is D. Wyoming statutes mandate that forms for variable life policies must be filed at least 30 days before use to allow the commissioner adequate review time. Reason A is not correct. 20 days does not satisfy the statutory 30-day pre-use filing requirement. Reason B is not correct. 60 days is longer than the required period and not specified in the rules. Reason C is not correct. 45 days exceeds the minimum filing window but is not the statutory deadline. Question 97. Under Wyoming statutes for variable products, at what point must a life insurer deliver the prospectus to an applicant for a variable life policy? A. Within 10 days after policy delivery. B. At or before signing the application. C. Within 30 days after application receipt. D. At the time of the first premium payment. The correct answer is B. State and federal regulations require the prospectus for a variable life policy to be delivered at or before the time the application is executed. Reason A is not correct. Delivery within 10 days after delivery does not meet the requirement for pre-application disclosure. Reason C is not correct. A 30-day post-receipt window fails to ensure informed applicant consent before purchase. Reason D is not correct. Delivery at first premium payment could occur after application execution, violating disclosure rules. Question 98. Which standard governs Wyoming insurance producers when recommending variable life contracts to clients? A. Best interest standard, requiring agents to prioritize policyholder interests above all. B. Need-based recommendation standard focusing primarily on individual financial objectives. C. Fiduciary standard imposing a trust relationship with every policyholder. D. Suitability standard requiring reasonable grounds for the recommendation. The correct answer is D. Wyoming regulations impose a suitability standard, obligating producers to have reasonable grounds that the recommended variable contract fits the client's profile. Reason A is not correct. A best interest standard is not codified in Wyoming for variable insurance recommendations. Reason B is not correct. Need-based recommendation is a general concept, but not the statutory standard for variable products. Reason C is not correct. A fiduciary standard is not required by Wyoming insurance statutes for producers. Question 99. A newly licensed insurance producer in Wyoming plans to offer variable life insurance products. She has completed the insurance licensing requirements and filed all state fees but has not yet passed any securities examinations. According to Wyoming law, which additional prerequisite must be fulfilled before she can sell variable life contracts? A. Obtain approval from the Wyoming Insurance Commissioner for variable product sales. B. Secure an appointment from an authorized insurer to market variable life policies. C. Post a surety bond with the state for variable product authority. D. Register as a representative with a FINRA member broker-dealer. The correct answer is D. The correct answer is registration as a FINRA representative, because variable life contracts are securities and require securities registration before sale. Reason A is not correct. Commissioner approval is required after registration, but is not the statutory prerequisite for offering variable life securities. Reason B is not correct. Appointment by an insurer is a contractual relationship and follows registration, not a registration prerequisite. Reason C is not correct. A surety bond is not mandated specifically for selling variable life contracts under Wyoming securities law. Question 100. A Wyoming insurer is designing a new variable annuity contract. In compliance with state regulations on mortality and expense risk charges, what is the maximum annual charge the insurer may impose on the contract's separate account value? A. 1.50%. B. 1.75%. C. 1.25%. D. 2.0%. The correct answer is A. The correct answer is 1.50%, because Wyoming law caps the mortality and expense risk charge at 1.5% of the separate account value annually. Reason B is not correct. A 1.75% charge exceeds the maximum allowed by Wyoming regulation. Reason C is not correct. A 1.25% charge would be below the allowable maximum, but does not represent the statutory cap. Reason D is not correct. A 2.0% charge is above the permitted cap for mortality and expense fees. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.